Hi, I'm Martin with JML Mortgage. Welcome to Mortgage Minute Monday. Today we're going to discuss the differences between interest rates and APR, or annual percentage rate, and why they matter. First of all, a low interest rate is very attractive to most borrowers, right? Unfortunately, they don't give you the full story when trying to make a decision on what the best loan is for you. The interest rate speaks only to the amount of interest that you're going to pay for borrowing a particular sum of money. Now, the APR is going to speak to the total cost of that loan. So it's going to not only include the interest rate that you're paying, but also it's going to include many of your closing costs, things like appraisals or settlement fees, closing fees. Um, you might have mortgage insurance or pay points to buy down your rate, processing fees. All of these items can add a significant or have a significant impact on interest rates and their affordability. So the APR is calculated over the entire life of the loan, generally 30 years. And it shows you what the loan actually, or the actual cost of the loan on an annual basis. The monthly payment, however, is only calculated on your interest rate, not the APR. So when we're making a decision, we generally are going to put a little bit more weight on the interest rate versus the APR. Now, although really for two major reasons. One, although the APR is telling us what the loan costs, it certainly doesn't tell us who's paying for it or who's paying those costs. So you may, not in this market, but in many, you may get a seller credit. The seller may come to the table and cover your closing costs. Or you may opt for a slightly higher rate in exchange for a lender credit, or the lender will provide you funds to obviously go towards those closing costs as well. Now, in both of those situations, you're not paying for those closing costs, but they're still going to be part of your APR. Secondly, the APR is not entirely accurate. For instance, if you're required to carry PMI, or private mortgage insurance, on the loan, the APR assumes that it's going to be there for 30 years. Now, in most cases, particularly on a conventional loan, that mortgage insurance can be removed when the loan to value of the home reaches 80%. In this market, again, that may only be 1 or 2 years with appreciation. So it's not a true picture of really how long you're going to be paying for it. And in addition to that, most of us aren't going to hold a home for 30 years and pay the loan completely, right? We move every 5 to 7 years is the national average. So why even look at the APR if it doesn't affect my payment? It's a good question. One good reason that is when you're comparison shopping for a mortgage, it's the easiest way to determine who's offering you the best loan or the best pricing. If you have two interest rates that are side by side and they're identical, if you look at the APR, that alone is going to tell you who's charging you more for the loan. So remember, one thing is very important. Regardless of your situation, the most important thing that you can do when you're choosing a loan is keep in consideration not only your budget, but your family lifestyle and your plans over the short term. Hope this helped, and if you have any questions, obviously give us a call. As always, we're happy to help you. We'll see you next week. Have a great one.